something I wrote about in my first book, One Rental at a Time, was there was a couple of 6 month windows where I just pulled back. One of them was right at the peak when I saw housing prices roll over because, that hadn't happened before. The second was kind of at the bottom when hedge funds came in and started buying the entire list of foreclosures, which I didn't know was a thing. But I think, Anna, we're entering that second 6 month window where things are just feeling like we're at an inflection or a pivot point, and some things may start to break. So I thought I'd talk to you, see if you're seeing the same thing. What do you think about the next 6 months? What do you see in the economy, in real estate, your portfolio? What's going on?
It's it's really interesting. I mean, we've lived through a lot, we've studied a lot, we've watched, changes in cycles. And oftentimes when there's a huge shift in an economy, it starts out kind of slow, right? You start to kind of come down the hill, and then all of a sudden there's this point where you've got this rapid fall, and usually then it kind of flattens and you have another rapid fall. And that's why, people that are wise investors say you got to be careful not to catch a falling knife, right? But you
Mhm.
also have to realize that once the knife falls and you hit kind of a bottom, the opportunity is there, but it doesn't last long, right? Because the bottom doesn't usually last that long. General recessions, 10 months, let's say 8 to 18 months, somewhere in there. And so, I think we're on that falling knife where the peak has clearly hit. There's pain, there's economic pain in commercial real estate and the banking system. We're on the verge of a recession. The question is it a soft landing or a hard landing? The softer the landing, the shorter the recession. The harder the landing, the longer the recession. And so I think we are in this place where if you're new, there's a lot of risk right now, right? Because we're not yet at the bottom. If you have experience and you have diversification and you've got liquidity and you can afford to make some mistakes or buy a property that maybe it does keep going down in value, but you'll be okay because you have the long-term perspective to ride that downturn and wait till it comes back up. Then do deals that you're comfortable with that mitigate the downside, and still have some upside. But I can tell you that as someone that's been doing this a long time, we are in a very uncomfortable pause period that's going longer than I like, right? I want to deploy money just like you do, just like we talked about in episode 2 today. But we are in a period where the reality is that in most markets, prices are still at the peak at the same time that interest rates are at a peak. And that makes it very difficult to create returns. And at the same time, we have lots of economic headwinds, if you will. There's a lot of uncertainty. There's a lot of risk in the market. And so when you have high prices and high interest rates at a period of high risk, when things probably are going to get worse, there's a maximum point of pain for a lot of people. Sometimes it's wiser to just wait it out a little bit unless you find a slam dunk deal and wait for the fall, wait till you're at the bottom. Once you're at the bottom, when you go from being uncomfortably quiet or still or feeling not productive, and everyone's afraid of real estate and we really hit a bottom, that's the maximum point of opportunity. But we're kind of in this funk of a period until then where it's like there's not much opportunity, there's a lot of risk. What do we do?
Yeah, I think that's all really well said. When I look at kind of the things that I'm looking at that would kind of make me feel better, one of the first things for me is we have to have validation that the Fed is done raising rates.
Yes.
Right now, there's a 50-50 chance, if you believe the market, that they're going to raise in June. I don't see it, but that's what the market says. So, one of the things I'm waiting for is validation that they're on pause. I don't need a cut. And frankly, I don't want them to cut this year because I think you cut, it kind of just restarts the animal spirits, if you will. I want
Right.
a validation of a pause. That's kind of the first thing I'm looking for.
Yeah. Yeah, I think that's good. And it's interesting because every week it's something different. Either we've won the battle against inflation, or oh no, it's back, right? And
Yeah.
so we're kind of like all over the place depending on the data. And it's because we're looking at, data reactively rather than saying kind of where are the trends going. And basically it It's very uncertain. Two of the Fed heads basically came out and said, we think rates might need to go to 6, like we're not near done.
Yeah.
And then that caused the markets to kind of panic. And others are saying, no, you know, we're going to have to pause because we are too close to breaking the banking system and rocking the consumer to the point that we have, you know, real economic risk and bank runs and those kind of things. So the uncertainty is what makes it so difficult to really know where are we going. So I think once the Fed, if the Fed comes out in June and they say we are going to pause, we're not going to raise rates, I think that that gives the markets and everybody else kind of some sigh of relief that maybe they really are going to see if the credit crunch and what's happening with lending is enough to kind of pull inflation down without having a hard landing. So we're all watching for that for sure.
Yeah. Then the other thing is kind of the specifically commercial lending. I think it was
Yes.
Jeremy Siegel talked about it could be as high as that it is getting so tight that it's acting like 3 or 4 rate increases. I know your network is full of far more folks than mine of commercial. I'm definitely more residential. What are they seeing out there? I have to imagine lending is quick. That's it's refi or new. It's just really hard today, I would think.
It's very, very difficult. And what I will say, you know, being in multifamily, we have Fannie Mae and Freddie Mac. And so that is basically government agency backed loans. And it's still, you know, the best loans that you can get. But I'll give you an example. So they might advertise that you can get 75 or 80% LTV, and their rates advertised right now, let's just say 5.5. There's kind of a spread, and there's a lot of things that make up what your rate is. But let's just say, you know, 80% LTV in a big city like Houston, Texas, or Raleigh, North Carolina, for example, bigger
Yep.
city. But the reality is, once they're underwriting deals, they're looking at, well, what if rates are higher later, and how does that impact your ability to refi later? And they're pulling back the amount they're actually lending you based on a forward projection in
Mm.
a negative environment. And so, what we're seeing for myself and some other investors that I partner with, I mean, we have decades of experience and huge portfolios, and we're still being quoted, 60% LTV, 65
Wow.
if it's a great property that's cash flowing really well today. And so the LTV is really pulled back. The rates are going up. And if you're not in a stabilized property that's already 90% occupied, stable rents, not a whole lot of meat on the bone, you're getting a no answer from the agency. So if you're trying to get bridge debt or a small bank lender to lend to you or a regional bank, you're getting 55% LTV offers on a really quality property. So the difficulty is that banks themselves, they have a lot of risk for the loans that are already on their portfolio. Most of them are not multifamily. They're retail, their office. That's where the big risk is right now because they're highly vacant properties and the values are coming down as interest rates go up. And so, they've got to deal with the stuff they have on the books. So if they're still going to lend you money, it has to be a really quality asset. And the last thing that I'll say before I kick it back over to you, Michael, is that not only are we getting low LTV offers, which when you have a low LTV, you got to raise a lot more money from investors that really want a much higher return on their money than what the bank is offering you in terms of the interest rate. And so most deals just simply don't make sense. They don't cash flow. They can't pay a safe return. And banks realize this. And so what we're seeing, we've actually been given term sheets by banks that have said, we will lend to you at 60% LTV and here's your rate, like a pre-approval in the retail world. And then them coming back and saying, we're so sorry, but we just had a board meeting. And based on the own things we have going on our own bank books, we can't offer you this loan anymore. We need
Yeah.
more liquidity. And so we have to hold reserves and we can't lend to you, on this project that's $100 million anymore. So that's happening over and over and over in commercial, not just to us, but many, many other investors that we know. It's getting really, really tight in the commercial space.
Yeah, Jamie Dimon was out, I think Monday, basically highlighting that this is occurring, not saying those exact words, but basically saying banks can't lend because they can't lend, right? They need more capital. They're nervous. They're whether
Yes.
it's deposit flight or whatever. Yeah, a lot of commercial banks, they won't even do 50% loans. right? They're
No.
just they're not in a position to do that. So that's kind of the second thing I'm waiting for. This too shall pass.
Yes, it will.
Uh, it's just the first inning, to use a baseball analogy.
Yeah.
So I, it's probably a year. It might be 2 years, but coming out of this, there will be opportunities, and it's going to be for the operator who has a track record, great liquidity. There are going to be some wonderful deals put forward. Um,
Absolutely.
we're just early. It just feels early.
We are. And, I've gone back and I've looked at every major recession since the Great Recession, since the Great Depression, I'm sorry, back in the 1920s. And typically what you see, especially in the commercial world, is that banks, especially in commercial, do not start lightening up until you're about 6 months past the recession, like past the middle of a recession. So,
Right.
a recession is usually not even declared until you've been in it about 6 months. And it's usually another 6 months beyond that before banks start to ease credit a little bit, raise LTVs a little bit, because they know that if you're at the start of a recession, there's more pain to come. So there's more defaults to come. So if they're worried about defaults of the things that are already on their books, and then you're, trying to buy something that's highly leveraged, they know that you, as a new owner of whatever asset, also have risk of default. They're just trying to protect themselves and stay open. And, to your point right now, they've got a lot of bonds, on their hold to maturity books that may have to be written down when they come to maturity. That lowers their asset value. They've got a flight of capital to money market funds and brokerage accounts that reduces their assets. And then they have liabilities, and those, liabilities have to have enough liquidity and reserves to offset them. And if assets keep coming down while their liabilities are possibly increasing without that liquidity, they're putting themselves at risk if they make a bad loan. And so they're just going to say, we're going to hold off on making loans, and, just try to have enough reserves and liquidity to stay afloat if the recession gets longer. So be expecting that you're going to start getting no answers from banks that gave you yes answers. And
Exactly.
that's very similar to what we experienced 2009, 10, 11. I mean, I had plentiful properties, but banks just kept telling me no. And you've got to have the resilience and understand now that this next year is going to be tougher to get loans. No matter who you are, how much money you have, how much experience you have, it's going to be tougher. So you've just got to not take no for an answer. You've got to pound the pavement. I mean, we're talking to probably 10 lenders a week on
Mm.
development deals and different things we have, because there is money out there, but sometimes you got to find it outside of the banks. You got to find, private equity firms and partners that'll joint venture with you, private money lenders. You're going to get a lot of no's from the banks. Expect that, but don't let it make you quit. You just have to not take no for an answer. You got to keep looking for other capital sources.
Yeah, and then the last thing I'm looking for in this kind of 6 month window is I'm looking for inflation, specifically CPI headline, to break below 4%. I think we have two kind of structural months called base effects rolling off, two big months. Then we have housing that will roll through in the summer. So I'm looking for that final validation, because again, if we get acknowledgement that the Fed is done raising, which I think comes first, hopefully, then we get clarity on the commercial banks, and inflation, gets far closer to 2%. That will be kind of the kindling for me to go like, okay, everybody else is scared right now. It's going to be time for me to get aggressive. That's the final thing I'm looking to have happen.
Yeah, no, I agree with you. I do tend to think it's hard to say. It really is. The bank tightening can cause so much tightening in the system that it really
Yeah.
helps bring inflation down, because people just can't, quite frankly, buy more stuff and
Yeah,
borrow in order to get it. And so it's kind of
exactly.
doing the job for the feds that the banks are tightening up. So that could cause inflation to come down a little more quickly. But, the dot plot plans and the things that I'm looking at, I think you're going to have a long 2024 before you really get there. So I don't think it's going to come down anywhere near the 2% in the next 6 months. But I think
No,
if you
no.
start to see that things are
Sub
going in
four.
the right
Yeah,
sub four, yes. If
sub
things are
four.
going in the right direction, and I think they will, by the end of the year be sub four, let's hope, right?
Mhm.
Then 2024, I think there's going to be a lot more opportunity than there is now, at least in terms of, the debt levels and the leverage that we can get, compared to today.
Yeah, and the reason all of this, again, I play far more in the residential than commercial, because the spread today between the 10-year note and the 30-year mortgage rate is astronomical. It's 320
Yes.
basis points. I believe if the Fed validates a pause, commercial bank kind of we get through the most of it, and inflation breaks below 4, maybe 3.5 in the next 6 months, you're going to see banks start to compete again, and you're going to see
Yes.
that 320 basis points come into a more 200, and that'll just mean homes get more affordable, right? Because you
Right,
whack off
because
a
they're
percent.
making that spread because of the volatility risk, because they don't know what's going to happen,
Exactly.
and so they have to make more money. Just like we want more money, we want higher returns for the risk. So do the banks. So
Yeah.
yes, I think especially in residential, your rates are going to come down. Not only because the Fed is dropping rates at some point or pausing, but also because that volatility,
Bars.
they can breathe a sigh of relief. So I think that's really good. The other thing that I'm trying to kind of keep on the forefront of my mind is, let's say these things take a little longer than we expect. It doesn't mean that we're not out there looking for deals. Like you and I are looking at deals every single day, but I'm looking at them differently and creatively and saying, where do I think things are going to go? Can I capture the volatility now, find opportunity to buy properties at a really good basis, with some creative financing that I can refinance when rates come down, and hopefully in the next year or two. So get out there and do creative deal analysis, right? So I just made offers on properties where I don't care what the interest rates are at the bank today. I'm going, what makes sense? What can I do that creates a win-win for the seller and for me as the buyer, because I'm trying to buy a bunch of properties, and I'm coming up with much lower interest rates than what I'm paying at the bank, interest only payments, which make my cash flow a whole lot better than if I had to pay principal and interest. And if I can help a seller out with capital gains by paying them interest only, it really creates a win-win. So you need to take advantage of these opportunities where creative financing didn't work really well in the last 2 years because there were too many people willing to pay cash and over asking. But this is a great time to take advantage of some seller finance type of deals. So look for those deals until the markets kind of start to stabilize, and you can still find some really incredible opportunities today, in the otherwise waiting period.
I love all of that. I do think seller financing or creative financing, whatever you choose to call that, increases in frequency over the next couple of years because, again, the last couple of years, stick a sign in the ground, it sells. The next couple of years, you're a tired landlord or you just want to move on to do something else. The only option might be seller financing. So you're absolutely right. And
Right.
again, you can negotiate terms, right? Your price, my terms, or my price, your
Absolutely.
terms. So pretty cool. Anna,
Absolutely.
where can people find you?
Great. You can find me here every week on our show. You can find me on social media at Anna Kelly, REI Mom. And if you're interested in coaching or consulting related to real estate or creating a plan for your investments, you can find me at my website at reimom.com.
Thank you so much.